And now, with plenty of foreshadowing from, I think, every speaker on the stage so far has mentioned in some way, shape, or form the industry and the taxes on it, because the industry doesn't need much introduction in this state. I'd like to invite Rob and Brena to begin our discussion of oil taxes.
Thank you all. It's my pleasure to be here with you tonight. Let me frame what I'm going to talk about within the context of what's been said, because there's a lot of things that I agree with. The first thing that I want to frame is that this isn't about oil taxes. This is about getting a fair share from the sale of our own oil. Now, it's our oil, it's our land, we should get a fair share. Everybody out there, raise your hand if you don't think that Alaska should get a fair share from their own oil. I don't see a single hand in the room, including from the person that's going to follow me. Okay, we should get a fair share of our oil regardless of whether we make cuts or don't get cuts, or how we spend our money. We should get a fair share before we go spend our savings or cut our PFDs. It makes no sense at all to spend our children's future or cut our PFDs while we continue to give away our oil to multinational corporations that are making twice as much in Alaska as they are in other major oil provinces. We should get our fair share before we tax ourselves. Does it make any sense to anybody out there to start taxing ourselves so we can continue to support giving away our oil to these companies? If we keep more of the revenue and wealth from our oil creates, we won't have to tax ourselves. You know, the idea of taking from our private sector and giving to our public sector doesn't add anything to the pie. We need to keep our oil wealth, more of it in Alaska and less of it from leaving Alaska. Governor Hammond had a famous quote. He said, if the day ever comes, and a prophetic quote, if the day ever comes when you don't have enough money for essential services in Alaska, the first place you should look is to be sure we're getting our third fair share from our oil revenues. You should do that before you consider broad-based taxes such as sales taxes and income taxes. So I don't disagree that this is a multifaceted problem that may require lots of solutions, but let me be absolutely clear as to which solution should come first. We shouldn't be giving away our oil and taxing ourselves and spending our savings and cutting our dividends. We should get a fair value for our oil first before we evaluate any other option. Alaskans aren't getting a fair share from our oil. We're giving up about $1.5 billion a year in tax breaks, unnecessary tax breaks, when Senate Bill 21 passed. We were promised more revenue, more investment, more jobs, and more production. We got none of them. We've lost 11,500 jobs, 5,500 in the oil sector. Our production has dropped. The investment that we gave away this money to get to create jobs, do you know what the 3 lowest years of investment on the North Slope have been in the last decade? The last 3 years. We are not getting investment for giving away our oil. We are losing investment and giving away our oil. How do we get our fair share? 2 major sources, as you saw, from royalties and production taxes. The royalties we get are 12.5%. That was embedded in an act in 1920, the Minerals Act. We get half of a modern royalty. Texans get 25% of a royalty. With regard to the production taxes, all of our taxes together, production taxes, income taxes, and corporate income taxes, all of those combined or 1.5% of the gross revenues that are leaving Alaska. Our production tax has been negative. You want to know why we're in the situation we're in? There's the slide. 5 years before Senate Bill 21 passed, we had $19 billion in revenues. 5 years from the production tax. 5 years after, we've lost money. This is 5 full years of revenue under our production tax. Now, the numbers you saw earlier had a positive number on that side. I've subtracted the credits that we have to pay from the amount that we get, which is the only fair thing to do. In fact, we are having to borrow $1 billion to pay production credits that we owe that we haven't even been able to afford to pay yet. So, in closing, because I see the red sign, let me say, let's keep some more of our money in Alaska. Let's get a production tax that works, and let's support Alaska's fair share from our oil, because all the solutions, if we can't get a fair share out of Prudhoe Bay that we're giving $740 million of credits to a year, if we can't get Prudhoe Bay right, then we've got the solution wrong. Thank you.
Many thanks to Mr. Brena, and I'd now like to welcome Mr. Roger Marx, who is our last but certainly not least speaker.
Maybe the least. So, is this coming through okay? Good? Okay. So Common Ground asked me to come out tonight and discuss my concerns with the Fair Share Act. And my organizing theme is to be focused on certain accounting perceptions that seem to be driving the initiative, which, in my judgment, are problematic. And the first of these goes to the very heart of what the initiative says fair share is. On their website, the initiative says that fair share is the state getting 1/3 of gross revenues. And they say that because they say, Jay Hammond said that gross revenues should be split 1/3 each to the state, the federal government, and the producers. Now, it's not clear that Hammond said exactly that, but regardless, that's a problematic approach, because gross revenues have to be split 4 ways, not 3. There's what the state gets, what the feds get, what the producers get, and the fourth piece is the upstream capital and operating costs incurred by the producers. These costs take up nearly 50% of gross value, and if the state's getting 33%, the producers are left with far less than 1/3. Nevertheless, the notion of the state getting 1/3 of gross revenue drives all the terms of the initiative. So if you want to see the concerns with the initiative, this is it on this graph. There are 3 lines on that graph. The left axis, the bottom axis is oil price. The left axis is what we call government take. It's the total state and federal taxes and royalties as a % of income. It's what many economists use to measure competitiveness. The bottom solid line shows the take from those jurisdictions where Alaska competes for investment. It's the average of 12 other places with tax and royalty regimes in the lower 48, North and South America, and Europe. It can be considered the competitive norm. The North Slope was developed by market forces, and the idea is fair share is what you can get in a competitive environment. That's what I think fair share is. The middle dotted line shows where Alaska currently is. It shows at low prices it's above the norm, at high prices it's above the norm, and it's competitive in the middle. And the top dashed line shows the initiative. This is what the state getting 1/3 of gross revenues looks like. It's a 340% tax increase, way above the norms. The per barrel credit, if you want to see what the current system looks like without the per barrel credit, the top line, the initiative, that's it. The 340% tax increase in the mid-range of prices consists of nothing but the elimination of the per barrel credit. The credit does not act like a credit in a traditional sense. It was designed to give the current system the shape it has. The same results could have been accomplished with a progressive tax table without calling it a credit. Think about the IRS eliminating your standard deduction. Other North Slope credits will be entirely phased out this year, and If you looked at the common ground graph of oil revenues each year, you notice the production tax was quite positive every year. The state owes money for past credits, about $700 million. That's what accumulated since starting in 2007 on a yearly basis. That's far, far less than what's come in with the severance tax. Those credits were put in place under ACES in 2007. They're owed to small companies. Their liabilities, and the state will still owe them whether the initiative passes or not. The thing is, we've tried this before more than once, and it didn't work. In the 1989 oil tax change, just like the Fair Share Acts, puts high oil tax rates for big fields. It provided a short-term revenue boost, but within months of that passing, the producers start switching investments from the high tax field to the low tax fields. And in the existing fields, once you stop investing, production goes into free fall. The tax became anemic, and production and revenue dropped. And the only difference between then and now is now they can switch their investments into the federal acreage where the state royalties will be much less. Under ACES, fiscal terms were way above the competitive norms. Producers made a lot more money everywhere else. Again, there was a short-term revenue boost. Production dropped 200,000 barrels a day in 6 years. In the last 7 years, with a competitive system, production has been stable. With more barrels, we're getting more revenues. The bottom line is you cannot yank $1.5 billion out of investor cash flow without them modifying their behavior. Finally, one more issue of problematic accounting is perceptions about Alaska profitability. A lot of people look at ConocoPhillips' combined per unit oil and natural gas profits and conclude Alaska is the most profitable place in the world to produce oil. In Alaska, ConocoPhillips operations are 100% oil. Everywhere else, they're about 50-50 oil and gas. And since oil and gas are produced together, their per unit profits are reported together. They're combined based on BTU content, but the BTU of oil is worth about 5 times as much as a BTU of gas. So when you blend oil and gas for financial reporting, you dilute the high-value oil with the low-value gas. So when you compare Alaska with other places, you are comparing the diluted operations everywhere else with the oil operations here. So in conclusion, much of this issue is about accounting. It's technical, and it's important, and I hope in the coming months, Alaskans understand these things before they vote. Thank you.
For Mr. Brena, I think that I've heard a number of different instances that stability is king. And not just talking about the oil industry, but anytime you want to promote investment in anything. So I heard you sort of making the statement that the first place we should look is making sure we're getting our fair share from oil, but that makes it sound like that's where we're going to go and sort of change up our tax system every time we can't fill up the gas tank. So why do you think that we should be sort of looking there first instead treating oil as a nice to have thing and then just attempting to get the best deal that sort of works best for us?
Well, let me say that there's a lot of married folks in this audience, and you know that if you want stability, you have to be fair, right? I mean, am I wrong? So if you want a stable relationship, then the first thing you have to do is be fair to your business partner, your spouse. That's the first thing you have to do. So it comes back to what is a fair share. The Fair Share Act isn't based on a third, by the way. It's $1 billion increase. At least I learned where their 350% talking point came from. It came from a wrong calculation. So what we're doing, we're saying, Hammond said a third of gross. We're not after a third of gross. The average percent of gross over the last 40 years before Senate Bill 21 was set 27% of gross. If the Fair Share Act, when the Fair Share Act passes, we will have under our average for the last 30 years. Under our average, we'll be at about 26%. So we think that in the last 5 years, the industry has been given about $1.5 billion in tax breaks by the state, and they've been given about $600 million in tax breaks by the federal government. about $2 or $2.2 billion. What the Fair Share Act does is ask for about $1 billion of that back. And we think it's a fair share. We're not even going up to our historic average. And since oil started flowing on the North Slope to today, we've managed to get our fair share and investment in Alaska. In fact, Sarah Palin had a 38% of gross. Right now, our production tax for the last 5 years has brought in nothing. It's been negative, nothing. And our royalty tax is 12.5%, which is half of a modern royalty. So we aren't close to our fair share. We aren't close to what Sarah Palin brought in during that other period. So I guess the answer is if you want stability, be fair with folks. The Fair Share Act adds $1 billion. That takes about half of the tax windfall that they've gotten over the last 5 years and keeps it in Alaska, and it's under our 30-year average. And if that's not fair to the producers, I don't know what is.
Now, Mr. Marx, I think that some of your comments were mentioned there, and you seem to be perhaps shifting in your seat a bit, like you had something to say. Did you want to respond to that? If not, I've got a question for you.
Well, I could talk a little bit about the whole idea of fair share and what you, but that's sort of that may be a side issue.
I thought maybe there was a particular thing you needed to get off your chest. So I think that when SB 21 went through, I was a bit younger than I am now, but I seem to remember a number of promises about increasing the amount of oil through the pipeline. Did that happen? And if not, what happened?
Well, I don't recall any promises of that. What the whole. I mean, I worked on the design of SB 21. The whole goal was to make it competitive with other jurisdictions in terms of this government take. Since, if you look at what happened in the 6 years ACES was in effect, the tax rates were way above anywhere else in the world. The marginal tax rate, when oil prices shot up over $100, the marginal tax rate under ACES was over 90%. And so that means when the price of oil went up $1, the government got 90 cents. So companies couldn't make any money doing here, so they just invested everywhere else. And that era, prices went up nearly to $150 in 2008. That was a golden era in terms of oil investment, and it just bypassed Alaska completely because investment. There's just no reason. It was nuts to invest money here where you couldn't make any money. Production dropped 200,000 barrels a day. If you look at the Department of Revenue production forecast in 2013, before SB 21 passed, had SB 20, and these forecasts were always optimistic, but they were forecasting in this year, 2020, if ACES still is in effect, we'd have 100,000 barrels a day less now, and that was at a forecasted price of $120 a barrel. If you look at what's happened since SB 21, production has been stable. It was about 500,000 barrels a day when SB 21 passed. It's been stable since the last 7 years, and and look at today's prices, $62. So we're getting 100,000 barrels a day more at a price of $70 less.